The festival season is already here, and so is the season of sale and discounts. Everything from branded clothes to accessories to electronics, smartphones, and even motorbikes are available on easy EMIs. There are only few companies that make money no matter how many customers buy which products of which brands. Any guess who they are? Well, Bajaj Finance is certainly one of them. In financial year 2022-23, India's largest non-banking financial company disbursed 29.6 million loans. Yes, that's Bajaj Finance. For Bajaj Finance, it was the highest ever, representing a growth of 20% over the previous year. The company operates in 3,733 locations across the country through about 155,000 distribution points. So last fiscal, Bajaj Finance acquired a record 11.6 million new customers through this network. It thus took its existing customer franchise to 69.1 million by March 2023. Now that tells you trying to fund every other smart TV or smartphone or motorbike is no small feat. But Bajaj Finance is undisputedly the largest lender for financing discretionary spends across consumer electronics, furniture, and digital products in India, both urban and rural. Now, as an investor, the question that crosses your mind is the profitability of lending at such scale. Whether at all the stupendous growth that Bajaj Finance has witnessed over the last decade is sustainable, and whether the lending is done at attractive margins with good asset quality. Now, one look at the non-banking finance company's past financials will tell you that it is extremely well capitalized. Plus, the return on equity of over 22% is one of the best in the industry. So, why should the company look for additional funding? Well, as per reports, Bajaj Finance is looking to raise nearly $1 billion this fiscal, and there are concerns about the usage of such funds. What if I were to tell you that Bajaj Finance is not an ordinary NBFC hoping to make bigger margins by offering loans at steeper rates and hoping for lower NPAs? Rather, it is a data giant leveraging technology. Tech like AI is used to mine the borrowing needs and patterns as well as the eligibility of underserved Indian customers both in cities and rural areas. Now, why is Bajaj Finance a data giant? Consider this. Bajaj Finance funds about 30% of electronics, 15% of smartphones, and 10% of organized furniture sold in India. This financing construct provides Bajaj Finance with massive amounts of customer data. This data not only helps the company filter out the good customers from the bad, but Bajaj Finance can also take a call on what sort of product should be offered to which customer. For example, assuming there are 1 million lawyers in India, Bajaj Finance has mapped out the data on each of these lawyers to take accurate credit decisions. Some of the data points Bajaj Finance captures are repayment history of the customer, banking details, education, employment, etc. Using these data points, Bajaj Finance has created hundreds of clusters for every segment that it lends to. So, deciding critical aspects like amount of loan, tenure of loan, rate of interest is based on AI models rather than subjective decisions. Building franchises. Now, Bajaj Finance is building franchises like large banks. Just like the large banks, Bajaj Finance has been able to reduce its cost to income ratio from 45% to 35% over the last decade. However, it was relatively late entrant in the consumer financing space. Plus, it had the handicap of not having a ready-made customer base. Bajaj did this by creating a cross-sell customer franchise, which can be sold multiple products over and over again. Then there is a spend on AI, big data, and cloud migration. Bajaj Finance has ramped up its tech spending over the past 5 years, more so post the pandemic. Its IT expenditure nearly doubled in financial year 2022. This was thanks to the introduction of an omni-channel framework for its customers. The firm saw its total tech budget rising by close to a third, with its key initiatives around big data, cloud migration and more. Now, while the company's overall spends on its IT infrastructure in financial year 2023 was a relatively smaller share of total expenditure, its IT spending has grown much faster than the overall expenses over the past 5 years. And this has had an effect on the profits too. While the overall expenses have grown just under threefold over the last 5 years, net outlay in the company's tech budget has galloped 4 times. This is in sync with the profit that has more than quadrupled in the same period. Bajaj Finance has also transferred its entire data ecosystem and analytic workloads to the Microsoft Azure cloud platform. In its latest con call, the management said, technology is at the forefront of Bajaj Finance's business transformation journey, and it has continuously leveraged existing and emerging technologies to launch new products, accelerate customer acquisition, and improve customer experience, along with simplifying the back office processes. Further, Bajaj Finance has also acquired 41.5% stake in Mumbai-based Snapwork Technologies in 2022. Snapwork offers consulting and implementation of software and related products for banking clients. So, Bajaj Finance may continue to look for similar acquisitions going forward. Now, all this tells us that while the concerns over the billion-dollar fundraising plans are valid, there's a high chance that most of the fund would be used to leverage technology for growth. So, if Bajaj Finance is a must-have NBFC on your watch list, which are the 2 things that you must track? 1. Funding impact on the business. The key objective of the tech-led growth would be to sustain a growth of over 25% in assets under management. Being able to do so while keeping the non-performing assets low and plowing back enough profits for shareholder returns can make the stock a consistent compounder over the coming decade. So, do keep a track on these critical metrics like NPA and return equity. Second, the funding impact on valuations. What typically happens in the case of fundraising plans of financing entities like banks and NBFCs is that the new funds go straight to the book value of the company, assuming it's only equity funding and there's no debt. So, stocks that are valued on the basis of book value are automatically re-rated. At times, if the return ratio is expected to get diluted because of the fundraising, the entity may also trade at a discount. For Bajaj Finance, the proposed fund rating could account for around 15% of its current net worth. Also, it could temporarily dilute its return equity by about 2%. So, one can expect the incremental impact of the funding on the valuation of the stock to be about 10 to 13%. This certainly makes the stock appear relatively more attractive to long-term investors. However, please keep in mind that such temporary spurts in valuation metrics can be misleading. Rather, it is the combination of tech-enabled lending, profitable growth, and transparent credit policies that could make Bajaj Finance a good contender for your watch list. Hope you like this video. Thanks for watching.